Account management, aging of accounts. What is aging of accounts? Aging of accounts is the practice of itemizing certain types of transactions into time buckets to show how far in the past they were initiated. So, aging of accounts, ito yung method na ginagamit ng accountants and investors to evaluate and identify any irregularities within a company's accounts receivable. Companies apply aging to understand the effectiveness of its credit and collection functions and para ma-estimate nila yung potential na bad debts. Accounts receivable aging is useful in determining the allowance for doubtful accounts when estimating the amount of bad debt to report on a company's financial statements. The accounts receivable aging report is useful to estimate the total amount to be written off. In accounting, aging of accounts receivable refers to the method of sorting the receivables by the due date to estimate the bad debts expense to the business. Next is time bucket. Is the period of time such as 0 to 30 days old, 31 to 60 days old, 60 to 90 days old, and 90 plus days old. The purpose of the time bucket is to collect demand events within the time window in order to make a joint supply order. And also, time buckets are the particular time frames that you spend doing your everyday tasks, like meetings, exercise, family time, and etc. This may vary slightly depending on your business and the events currently unfolding in your life. Accounts receivable arise when the business provides goods and services on a credit to the clients. For example, you may allow clients to pay goods 30 days after they are delivered. They represent an asset to the business. So para ma-identify yung average age of receivable and potential losses from clients, businesses regularly prepare the accounts receivable aging report. This allows them to collect these bills as soon as possible to move the money into the bank account. The account receivable aging report will list each client's outstanding balance. It is then sorted into columns such as due date, 1 to 30 days after due date, 31 to 60 days after due date, 60 to 90 days, and over 90 days. The aging schedule is a table that shows the relationship between the unpaid invoices and bills of business with their respective due dates. It's called the aging schedule because the accounts receivables are broken down into age categories. It indicates the total accounts receivable balance that have been outstanding for specified periods of time. The aging schedule lists accounts receivable that are less than 30 days old, less than 40 days old, or more or less than 90 days old. This is used for determining which of its clients are paying on time and may also be utilized for cash flow estimation. An aging report is useful because it gives you a snapshot of the money that is outstanding and due to you by your customers. It also helps you identify customers that are falling behind on their payments, a clear sign of an underlying problem.